Hello friends, welcome to our lecture series on financial management. This is going to be part 2 of my lecture series on valuation of securities. Myself Aditya P. Tripathi, I am here to continue our discussion on the topic of valuation of security. In today's lecture of mine, I am going to tell you about the valuation of securities. In the previous lecture of mine, I told you about the basics of this bond valuation, the valuation of securities, different terms which are used into the valuation of security. We also had a discussion about the different terms which are used into the valuation of securities, different types of values. Now it's time for us to understand the way we have to practically calculate the value of my security. So I'll be starting with the valuation of bond, the different theorems and how to apply it, and then we'll talk about some other securities like preference shares, equity shares, and all. So let's start with the bond valuation model. I told you in the previous lecture of mine what exactly we mean by bond. Bonds are actually, they are as good as debentures, but as far as Indian scenario is concerned, when we say bond means we assume that they are issued by the government institutions, government entities, like Reserve Bank of India is having its own bonds, or some private entities are also having their own bonds. But as far as Indian scenario is concerned, there is a kind of, you can say, inculcation. It is a wrong inculcation that we assume that bonds are basically issued by the government entities only. It can be issued by private entities also. It is as good as your debentures are. Valuation of bond is basically regarded as quite easy and simple. The question comes, why it is so easy and simple? The very basic reason behind this is the availability or certainty involved into this computation process. The reason for calling this particular valuation to be easy and simple is that cash flows are known with certainty and normally are in annuity form. As far as bonds or debentures are concerned, they are always having a prefix of a certain percentage, that is say 8% debentures, 10% debentures. So this particular prefix is indicating that this is the value I am going to get out of my debenture on account of return. So that will actually tell me that this is the return I will be generating annually. I am very much sure that the moment I am going to buy this debenture, I will actually be getting this much of return annually from this particular security. So this very basic nature of, or you can say the very basic characteristics of this particular security makes it quite easy to calculate and simple to understand. So since the cash inflows are known with certainty, the maturity amount is known with certainty, that too in annuity form, it is quite easy for us to calculate. Suppose if we have to calculate the intrinsic value of a bond, we have to classify the computation process into two parts. The first part will talk about the routine cash inflow, whereas the second part will tell us about the maturity value. So if we classify it into two parts, on the left hand side we show the interest. Interest is basically the annual return which I am going to get out of my security on annual basis. So interest divided by 1 plus cost of debt, that is whatever is the rate of discounting, and to the power t, that is time, I am actually discounting the value of interest. So present value of my routine cash flows, present value of my future interest which I am going to receive, and then I will be adding the maturity value which is indicated by f divided by again 1 plus kd to the power n, cause that amount, maturity amount, I am going to get at the end of the life of this particular bond which I am going to evaluate. So in case of intrinsic value of a bond, we have to classify the future cash flows in two broad parts. First is your routine cash inflow which will be receiving on annuity basis, and second is the maturity value which will be receiving at the end of the life of that particular bond or maturity period. So the first part is actually telling me about the fixed annual interest payment, whereas the second part is telling me about the fixed principal repayment. So principal repayment is actually indicating that this is the amount the investor is going to receive at the end of the maturity period, and from company's perspective, this is the amount which we have to pay at the time of redemption, or you can say at the end of the redemption period we have to shell out this money. So after aggregating the present value of these two components of cash inflows, we can very easily calculate the intrinsic value of a bond, where I is actually indicating the annual interest and f is indicating the principal amount payable at maturity, kd is my cost of capital, and n obviously we understand the maturity period of this particular bond. So in this way we have tried to understand how to calculate the intrinsic value of a bond with a very simple formula: interest upon 1 plus kd to the power t plus f divided by 1 plus kd to the power n. So there are two aspects to it. This you have understood. First aspect is telling me about the fixed amount of interest which I will be receiving on annual basis, whereas the second part will actually indicate the maturity amount which I am going to receive at the end. Now there is another point, that what are the different measures of bond yield. When I say yield means the return which I am going to get out of it. The first very term which we are using into the bond yield measure is the 1 period rate of return. When I say 1 period, it can be for a given period. It can be for the period in which you are retaining that particular bond, and you are willing to calculate the return for that effective period. Suppose I bought a bond today and I am retaining it for 1 year. So at the end of 1 year, or you can say the expected period, I am going to get some maturity value. So initially I paid certain amount, then at the end I am going to get certain amount. I need to calculate what is my 1 period rate of return, that is what is my rate of return for this effective period in which my money was blocked, or you can say amount was invested. So it is the first measure of bond yield, that we have to calculate 1 period rate of return. It is quite simple for us to calculate. If you look at the formula, we'll start with the price gain or loss during holding period. So during holding period, we have to first find out the difference between the two prices, the one which you paid and the other which you are going to receive. So at the time of purchase, the price which I paid, that will actually be my price paid, and the price which I am going to receive at the maturity, that will actually be my return in terms of price. So it can either be, there can be two possible situations: either it is going to give me some gain, or it can cause me some loss, or to the max, in case of neutral situation, there is no profit, no loss. So we have to first find out that what is my price gain or loss during the holding period. Once it is calculated, I have to add coupon interest into this particular gain or loss. So suppose if loss is there, after adding coupon interest, the plus minus adjustment will be done, and I will get the net amount which I have gained out of this particular holding of this particular bond or security. So for this particular effective period, this is the amount which I am going to get from my this investment. So we have to first calculate the price gain or loss during the period for which I am calculating the rate of return, and then I will be adding the coupon interest. When I am saying coupon interest, basically coupon is what? It is the rate. So the rate of interest which is given in that particular policy document by the company, that is going to be my coupon interest. And after aggregating these two components, I have to divide it by the purchase price at the beginning of the holding period, because that is the base price. So at the beginning of the holding period, what was my purchase price? I have to divide this entire return on that amount. Now my dear students, I will tell you how to recall, how to remember this formula. If you understand the making of this formula, it is quite easy for you to understand. Suppose if I have to calculate rate of return, then obviously rate of return is on which amount? What should be the basis of computing the rate of return? The basis is my investment. So investment is going to be the denominator. Then what will be the numerator? Numerator will be the return which I will be getting. So the interest which I am getting is going to be my numerator, and the denominator will be what? It will actually be the purchase price at the beginning of the holding period. So whatever amount I have deployed into this particular bond, that will be my investment, and on this I have to calculate return. So return divided by investment. Whenever you forget the formula of return on investment or ROI, always recall the basic principle behind this, that rate of return is equal to return upon investment. So return is out of this bond, what do I get? I get price gain and I get interest on debenture. Aggregate both of them and calculate a percentage of it on your purchase price at the beginning of the holding period. The second point which comes to us is what is current yield in bond yield measures. The second way of measuring the bond yield is current yield. Now how to calculate current yield? The formula is coupon interest divided by coupon market price. Why do we call it current yield? Current yield is basically the yield or return which I am getting during the redemption period, or you can say across the life of that particular security, or from the company's perspective, the interest which company is paying across the redemption period. So every year whatever company is shelling out, that is going to be the current investment, current payment by the company, and for investor it is going to be the current yield. Suppose if I have to calculate bond yield measures, current yield is equal to coupon interest divided by coupon market price. It is quite simple. Since we have to calculate the present value of it, it can be computed by a functional formula. Price is equal to interest divided by 1 plus kd to the power t plus whatever the maturity value I will be getting divided by 1 plus k to the power n, and in this way we can calculate the coupon yield. So current yield. For yield to maturity, suppose if somebody is asking that current yield you have computed, how to calculate yield to maturity? For yield to maturity you have to combine interest as well as the maturity amount. So what is the difference between the current yield and yield to maturity? Current yield is only telling me what is the effective return I have generated out of this particular bond during the life of, or you can say maturity period of this particular bond. But when I say Y2M, that is called yield to maturity, it means I am interested in knowing not only the current yield but also the maturity yield which I will be getting at the end of the life of this particular bond, as far as bond valuation is concerned. So we have to aggregate, and since the amount I am going to receive in future, I need to calculate the present value of this amount, or you can say K is equal to interest plus F minus P divided by N whole divided by F plus P divided by 2. My dear students, if you recall the formula of cost of preference shares or debentures under redeemable category, I told you at the very outset while we were discussing about the cost of debentures in the chapter of cost of capital, I told you how to calculate the formula. There was interest into 1 minus T plus RV minus NP divided by N. Now the same RV, that is redemption value, becomes F here, and the NP, that is RV minus NP, that is net proceed, the price is represented by P, and N remains the same, divided by RV plus NP divided by 2. So the same formula which we used for computing the cost of debt or preference share is going to be used here also for computation of your yield to maturity. Because in yield to maturity we are not only considering the interest component, that is the revenue component, but also the maturity value which I am going to receive, and then we calculate the present value of it. So if it is quite interesting to discuss here. Suppose if you are clear about the concept of cost of capital, whatever company is paying as cost of capital, the same becomes the return for the investor. So when we talk about the valuation of security, suppose I am talking from the company's perspective. As a company also I can invest somewhere. So for my investors I was acting as a company, but for my investments I'll actually behave like an investor. So we have to understand that the way of calculating it remains the same. What changes is the way of looking at this entire computation process, and which is actually known as perspective. So it is actually the way we look at this particular computation process. If we are looking from the company's perspective, it becomes cost. If we look from the investor's perspective, it becomes value. So this is the way we have to calculate the yield to maturity. Now let us practically understand. With a numerical example, we have understood how to calculate 1 year or for an effective period what is return, current yield, yield to maturity. Now let's try to solve a problem and practically understand. The par value of the bond of LK Limited, there is a company called LK Limited, and the par value, or you can say the book value of bond of this company is rupees 1500. There is an investor called Ram who purchased this bond for rupees 1450. So the price of bond is 1500 and the investor has paid only rupees 1450 to LK Limited. The bond is carrying a coupon rate of 7%, which means the rate of return is 7%, and you have to compute certain things here. The requirement of the question is that you have to calculate the return on the bond if Ram is going to sell the bond for rupees 1650 after 1 year. So if Ram is going to sell out this particular bond after completion of 1 year at rupees 1650, what is the return? So for this we have discussed the formula already. We have discussed the formula with which we are going to calculate. So I'll practically be applying that formula. The second aspect of the question is asking us to calculate current yield on the bond if the current market price is rupees 1458. If present market price or current market price is 1458, what will be the current yield? the approximate yield to maturity if the maturity period for bond is 6 years and it is currently traded at rupees 1458, which was the market price. So the examiner or the question is asking you to do certain calculations in terms of bond value measures. So these are different measures, and all measures are fortunately present into a single question, and now you have to calculate. So let's start with the first value, that is the holding period rate of return. It is also called as holding period rate of return. Somebody will say 1 period rate of return. So 1 period, why we are saying? Because it can be a specific period. So depending on the situation, we have to decide that for which period you are calculating. It can be 1 year, it can be 2 years. So as I told you about the formula, let's recall the formula. In all chapters of financial management, you have to always recall the very basic formula, that what we have to do. So here, as I told you, we'll first calculate the price gain or loss during the effective period, that is 1 year for this question, and then we'll be adding coupon interest into this, and afterwards we'll divide it by purchase price at the beginning of the holding period. So what was the purchase price at the beginning of the holding period? With that we'll be dividing, because that is my investment. So return is in terms of price gain or loss during the period, and coupon interest, and my investment is what? The purchase price at the beginning of the holding period. So if you look at the question, rupees 1650 was is actually the market price when Ram is going to sell it, and rupees 1450 is the price which Ram paid at the time of purchase. So if we calculate the price gain or loss, obviously there is a gain, because you paid 1450 to purchase and you are selling, Ram is selling it at 1650. So effective return, effective gain is 200 rupees. Plus coupon interest, the rate is given and the price is given, face value is 1500 and the rate is 7%. We calculate, if we calculate the coupon interest, that becomes 105. And now you have to divide it by the investment which Ram has made. Ram has made the investment of rupees 1450. So the investment is actually 1450, and on this I have to calculate the holding period rate of return, that for the period for which you are holding, or Ram is holding this particular bond, whatever return we have got divided by investment. So 1650 minus 1450 plus 105 divided by 1450 will actually fetch me the value, and the value comes to be 0.21, and if we have to calculate the value in terms of percentage, multiply it by 100 simply and we'll get a return of 21%. So we can say that by investing rupees 1450 for 1 year, Mr. Ram has actually generated a rate of return of 21%. So you can say the effective rate of return for the Ram for 1 year is actually 21%. This measure is very useful, because at times investors are investing into the bond for 1 year or 2 years, and they are willing to sell it out to other parties. So it is quite helpful for the authorities which have issued this particular bond, because effectively the investor can calculate the holding period rate of return, and they can make use of this particular calculation process. The second aspect of it is, the second part of the question is asking us to calculate the current yield. Now we'll be calculating the current yield. Formula is known to as coupon interest divided by current market price. What is coupon interest? I told you, the rate of interest which is given, and the face value or book value is given 1507%. So if we calculate, the value comes to be 105. That is my numerator, coupon interest, and denominator is what? Current market price. My current market price of this particular bond is rupees 1458, which is given in the question. If we solve it, the value comes to be 0.072, and since we have to calculate it in terms of percentage, the rate comes to be 7.2%. So we can effectively tell the investor, or we can for our consumption also, we can infer from this particular value, from this particular data, that the current yield on this bond in which I have made the investment is 7.2%, so that we can have a comparative opinion about other options of investment. So current yield comes here is 7.2%. The third part of the question was asking us to calculate YTM, that is yield to maturity. Approximate yield to maturity can be computed with the formula which I told you, that interest plus F minus P upon N divided by the average of F plus P, that is the maturity value, and the price of that particular security. My dear students, when we talk about yield to maturity, it means it is indicating that this yield is in terms of maturity. We are talking from the perspective or with the perspective of yield to maturity, that including the maturity component, what is my yield, what is my effective rate of return. So we can very simply calculate. Now we have aggregated both the components. Interest is 105 plus face value is 1500, price which I paid is price which is available here in the market, current market price is 1458, divided by the maturity period that is here in this question 6, whole divided by 1500 plus 1458 divided by 2, or you can say the average of it. And in this way we come to know about YTM, yield to maturity. This rate comes to be 7.6%. So current yield was 7.2% and yield to maturity is 7.6%, slightly higher than what you are getting on account of current yield. If you try to dissect these two values, you can easily understand what is the role of maturity value. Since the change in the current yield is very nominal, then obviously you can infer from this particular value that maturity value is not contributing significantly to the rate of return. The reason is the price is not changing much, or we can say that it is less than the face value. Face value was 1500 and the price which I am going to get in the market is 1458, which means that the maturity value is not giving me the greater return, and that is why the contribution of it to the yield to maturity is very insignificant or very nominal. So with this computation of these different values, we can understand, we can actually draw the inferences about the current yield, about the effective yield for a given period, about yield to maturity. So with this example, I tried to explain you the way we can calculate the value of a bond, the yield to maturity, and the return for a specific period. Now there is a very established notion into the valuation of bond, that there are certain theorems developed by, or basically these are not theorems, I would say these are inferences which are drawn by the financial experts. On the basis of different situations, they have given certain propositions which have actually in due course of time become bond value theorems. So I'll first be telling you what are those theorems, and then with the practical example we'll try to understand. But we have to understand what is the role of these bond value theorems. Basically these theorems are helping us in analyzing the effect of so many factors on bond values. The first factor is relationship between the required rate of return and the coupon rate. So if we look at the bond value theorems, the components which are used there is the relationship between the required rate of return and the coupon rate. Second is number of years to maturity. So it can also be a component, number of years to maturity, that at which distance you are talking about the number of years to maturity, then yield to maturity. So they are actually, bond value theorems are actually helping us in analyzing the effect of these factors on bond values. So what is the reaction of these values, what is the impact of these components on the value of my bond, that is something which is explained by these bond value theorems. So we'll try to discuss theorems one after other, and then practically also we will discuss. Theorems are basically showing that effect of the relationship between the required rate of return and the coupon rate on bond values. Let's start with the first theorem, where we'll talk about the effect of the relationship between the required rate of return, or you can say expected rate of return, and the coupon rate on the value of my bond. For this we have a theorem 1. What is the first theorem? It says that when the required rate of return is equal to the coupon rate, the value of the bond is equal to its par value. So if your required rate of return is exactly equal to the coupon rate or the rate of interest, the value of bond is going to be the same, that is your par value. So there is no change in the value of bond. What is theorem 2? Theorem 2 says that when the required rate of return is greater than the coupon rate, the value of bond is less than its par value. So try to understand, there can be three possibilities: equal to, greater than, and less than. So when the required rate of return, so required rate of return is going to be a deciding factor. When your required rate of return is equal to coupon rate, you have to understand, if my rate of return is, required rate of return is equal to the coupon rate, the value of bond is equal to the par value. But when my required rate of return is greater than the coupon rate, the value of bond is going to be less than that of its par value. So the value is going to decline. In theorem 3, what we are saying, the third possibility, when the required rate of return is less than the coupon rate, the value of the bond is going to be greater than its par value. So you can say there is an inverse relationship. If rate of return is greater than the coupon rate, value of bond is less than. But if the required rate of return is less than the coupon rate, the value of bond is greater than its par value. So these are the first three theorems with which we can practically solve a numerical and understand that how to calculate how to establish that, how to justify that these theorems, whatever they are saying, whether it holds true or not. Let's start with a bond. A bond of Preeti Limited has the following features. It is telling us that the par value of my bond is rupees 100, coupon rate is 10%, number of years to maturity is 3 years. And Preeti Limited is asking us to compute the value of the bonds in certain situations. There are 3 situations here in this question. Case 1 is saying required rate of return is 10%. Case 2 is saying required rate of return is 12%, and then if your required rate of return is 8%. Since we have got 3 different rates, we will actually be witnessing the impact of the change in required rate of return on the value of bond in different situations. So we'll actually have the value of bond which is equal to par value, greater than par value, and less than par value. So let's try to examine or justify that whatever theorem is saying, whether it holds true or not, because we should not trust any theorem blindly. Whatever theorems are saying, whatever inferences, whatever propositions they are giving to us or inferences they are drawing, we have to actually justify, because we have to give a quantified justification. As I told you that in the subject of financial management, we have no scope for I feel like, or it seems, or it may be. We have to be very clear that whatever my theorem is saying, whether it holds true or not. So let us solve it. In case 1, when your cost of debt is equal to 10%, then obviously if you calculate the value of your bond, the interest will actually be the routine amount. This you are going to receive for the entire period. So you will actually be calculating the present value of it by the way of present value annuity factor, and for the maturity value you will only be using the present value factor table. So with this, if you calculate the present value annuity factor of this 10 rupees by the use of PVIFA table, you will find the value of this particular routine income, that is interest, and then you can aggregate the maturity value, and if we multiply, we get a value of rupees 100. So it is proven here that when cost of debt is equal to coupon rate, what is happening? The value of bond is equal to face value. So whatever theorem said, it is proved here in case 1. So in situation 1, I tried to do the calculation so that I can justify whether whatever theorem is saying is true or not. Had I not been getting the same answer, I would have said no, the theorem is wrong. So theorem is saying that you have to examine the impact of your expected rate of return on this particular bond valuation. So if your expected rate of return is equal to coupon rate, then your bond value is going to be face value. So at times we suggest that no need to calculate the value of bond, because you are going to get the same value, the par value which is known to us. Now moving on to case number 2, where the cost of debt is going to be 12%. The same process we have to follow. We have to calculate the present value of routine cash inflows and then the present value of the terminal amount which I am going to get or the company is going to pay. If we calculate, the value comes to be 95.22. So this value is actually telling me that value of bond is here less than the face value, and it was also said by the theorem. Theorem said when cost of debt is greater than the coupon rate, what will happen? The value of bond is going to be less than the face value. Face value was of 100 and the bond value has come less than 100. Now moving on to situation number 3, where cost of debt is equal to 8%, which is which is actually less than the coupon rate, then obviously my value comes to be rupees 105.17, which is much greater than the par value, that is rupees 100. So we have understood that value of bond is greater than face value. So my dear students, practically what we have to do, whatever these theorems are saying, we are not supposed to follow them blindly. We have to actually numerically justify that whether whatever they are saying that holds true or not. I hope you must have understood these three theorems in the bond valuation. I hope you must have enjoyed today's lecture of mine. Thank you so much.